Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 22nd, 2025. Okay, let's get right into the dashboards. The first dashboard is the stock market indexes, 4 U.S. equity indexes, 2 foreign indexes, developed markets and emerging markets, and the long-term government bond ETF, TLT. In the yellow box is the results of all 7 of those indexes or ETFs last week. Isn't that interesting? All of them, including bonds, are positive. In the pink box, year to date, again, they're all positive. Quite unusual. And then to the right of that are the dots indicating above or below the 20, 50, 100, 200-day moving averages. All of those are positive except for one for one period. So basically a very positive report. Okay, now I'm going to go to the sectors. Sectors make up the S&P 500. All 11 major sectors are in the S&P 500. This is a breakdown of those sectors. Not unlike the indexes, they are all positive for the last week and year to date. Isn't that interesting? To the right of that are the red dots and green dots indicating above or below their 20, 50, 100, 200-day moving averages. So basically a very positive report for the market as of last Friday. The S&P 500, this is a 3.5-year chart. I put a black arrow in here so you can see clearly the direction of the S&P 500. Most of the time it was above the 20 period moving average. This is a weekly chart, so 1 move equals 1 week. But at the very far right, upper right, is a little tick up, and that shows last week, which was positive. And so it's staying well above its 20 period moving average, moving in a positive direction. Same chart, except on a candlestick basis. So it begins at the very bottom. It gives you a little better view when you look at the candlesticks, meaning that they are moving in an upward direction or downward direction. When I take the S&P 500 and just compress it down to 2025, so this would give us about 9.5 months of data. Two very different pictures here. One is at the beginning of the year, or at least in the first quarter, you see the big drop-off. What was going on then was tariffs. The announcement of tariffs, it seemed like every day or every other day there was a new tariff. We didn't know what that meant. Is that going to kill the economy, very inflationary, counter tariffs, negotiating tactic, whatever? We didn't know. So because of the unknown, the market reacted negatively, and that's what you see in the February, March, and early April. From that point, I think somehow we digested the news and figured out that it's not going to be that bad because the market said basically it's going up. So that is exactly what happened from early April until present. You see the direction. What we don't know is where it's going to go from here, but right now it is on a daily basis, it's kind of right at, maybe barely above the moving average. On the weekly chart you just saw, it is definitely above the 20 period moving average. A relative strength chart showing the NASDAQ 100 as the numerator and the S&P 500 as the denominator. And then I cut through the data with a 20 period moving average. At the very far upper right, you see the movement of this ratio, the ratio of NASDAQ to S&P 500. that ratio is moving up, telling you that this favors the NASDAQ 100 as the stronger of the two indexes. The S&P 500 has growth stocks in it and value stocks. That's all there is. You can break them into one of those two categories. And you see at the very far upper right, it's kind of a flat line. So that ratio of growth over value did not change much in the last week or the last couple of weeks. The S&P 500 as a numerator and the Russell 2000 small cap index as the denominator. So when it goes up, that favors large cap S&P 500. When it goes down, it favors small cap Russell 2000. In the last couple of months, the direction, the upper right, you can see the direction has been down. That has favored small cap over large cap. Same thing at the very, very far right. There's a little tick down for last week. Same thing. It favored small cap. The dollar has gone up and down for various reasons. Now, when I say the dollar, what I mean is the buying power of the dollar, the purchasing power. So as the dollar, over time, as the dollar gets, there becomes more currency in the system, then the dollar gets devalued. And so it has gone, the dollar has basically gone down over, what is it, 112 years, 112 years. But more short term, since the beginning of 2025, about, what is that, maybe an inch or so from the far right, the dollar, the value of the dollar, purchasing power, has gone down. It's been down about 10% since the beginning of the year. From 1913 to present, you could say it's at least down 95% or up to as much as 99% loss in purchasing power. So as they print more money, and I think even the Treasury borrows more money, I think both of them work in favor of diminishing the purchasing power of the dollar. This is the stock market. The S&P 500 as a proxy for the U.S. market compared to, on a relative strength basis, EWY, which is the proxy for the South Korean market. When you look at this from the beginning of the year to present, it has gone down, and one of the sharpest declines was this past week. It has been going down and down and down. Not the dollar, not the economy, but the market. So our market has weakened, is weaker than the South Korean market. Said another way, their market is much stronger. If we put in here, instead of this, we put in a European country or a Latin American country, I think to some degree it would be similar to this. Our market is not keeping up with the markets around the world. Okay, volatility index. This goes up and down, and what this measures is degree of volatility, usually downward volatility of the S&P 500. So when it goes down, that means reduced volatility, which usually means that stocks are going up, and vice versa. I put a black line in here at about 24, and that tells you that is my indicator of when I consider when it moves up through that line, that's usually an indicator that there is increasing risk coming into the market. It did that, and now this last week it corrected back a little bit, showing less downside risk. So we're not there yet, but you can see it's possible we could get there. The long-term government bond, TLT, is moves similar to the intermediate term bond and even similar to the short term bond. But the longer period of time, the long-term government bond has gotten a better rate of return. So I use it. This is a 6-year chart, and I put a green line in here to just show from now, the far right, back about 3 years, and you can see the price of TLT is about the same as it was about 3 years ago. And the direction is still in a downward direction. In the last 2.5 months, the line on the lower right has gone up. So that short-term move is positive, but sometimes that is the downward direction. The overall direction is down, but sometimes it needs to let off some steam, and it does things like this. Or the perception is that at some point rates are going down, meaning bonds are going up in price. That could be true. I think that the longer-term direction of interest rates is up, which means the longer-term direction of bond prices is down, if I'm right. Okay, gold. GLD is the ETF for gold. In the last month and a half, 2 months, upper right, look at what happened to gold. It is exploding, going up and up and up. It's not going to the moon. It looks like it is, but it's not. It will at some point turn around and come back down, or more likely, in my opinion, get to a point where it wants to take a breath and consolidate and maybe go sideways, more than up and more than down, just sideways in some fashion. But for now, it is going up. That is a function, I think, of supply and demand. It's also an indication that people do not have the confidence in the dollar, and they're looking for an alternative to the dollar, a form of alternative currency, if you will, and gold is that. And J.P. Morgan said in the early part of the 1900s, he said, gold is money. Everything else is credit. And that's frequently quoted. So gold has intrinsic value, as does silver. So, but over this 3.5-year period, and you could say the black arrow represents more of a 3-year period. In that 3-year period, it's mostly gone up. Everybody's scratching their head thinking, when is this thing going to slow down? It will at some point, but it hasn't yet. Silver, even more so. Silver is going up at a faster rate than gold. Silver is more volatile than gold. When they both tend to go up, it's not uncommon to see silver go up at a faster rate. Again, people are looking for an alternative to the currency, wanting to hold something of intrinsic value because of loss of confidence in the dollar. It's not just Americans. I won't say that it is even primarily Americans. It's probably other countries. They are transacting business in their own currency now, instead of the reserve currency or the petrodollar, which is the U.S. dollar, it's a long story, I'll save it for another time, became known as the petrodollar back in the 80s. But it's just looking for something where countries can have confidence in something other than the dollar. And I think gold offers that, and silver offer that alternative. Okay, Bitcoin. Bitcoin has not followed gold and silver. It does its own thing. It's correlated to nothing. And it has dropped below its 20-period moving average. But I would not say it's going down. I would just say it's basically in a consolidation period going sideways. Okay, I'll get into the detail of gold and silver. As of last Friday, the 17th, gold got to $4,250 for 1 ounce of gold. That's a lot. That is up 5.8% from the previous Friday. Silver is up to $51.86. It's broken through that $50 barrier that a lot of people, many people thought probably would not happen. It did happen, and now is moving on up beyond that. That's a 3.9% increase over the previous Friday for a gold-silver ratio, gold numerator, silver denominator of 82 to 1. When it is above, the magic number that a lot of people rely on is 30 to 1. When it gets down to 30 to 1, or let's say in that area, that favors gold as having a better upside opportunity. When it is higher than that, it means that silver generally has a higher upside opportunity. So when I say it favors silver, that's what I mean. One way when you buy gold or silver, you can buy it in a lot of forms. You could buy an ounce, a round, or you could buy a little bar, also an ounce. You could buy it in 5 ounces or 10 ounces or 100 ounces, various weights and shapes. And then the stamp on it, it could be the silver eagle or gold eagle. It could be the Buffalo or the Britannia. There's all kinds of them, and then the quantities, you can buy it that way, or you can buy a tube, which you see these tubes, and it has 20 ounces per tube, or you could buy a monster box, and this is a picture of a monster box, which has got 20 tubes in it. I think these might be 25 ounces per tube. So, but as a monster box, 500 rounds, generic rounds of silver, that is, as of Friday, was $26,835. That includes a $1.81 markup for the premium or the commission, if you will. The retailer typically will split that with the wholesaler. And that's how they stay in business, is the markup. That brings the cost per round to $53.67, the spot price plus the markup. Times 500 is $26,835. And you can buy that you can buy it online, which I don't recommend. You can buy it from a brick and mortar retailer, and you can buy it in various quantities. And then you can store it wherever you want. So I don't buy from online retailers. I buy from my son, who's a brick and mortar retailer, and you can store it wherever you want. I do not store mine in a bank. I don't like that option. There's a lot of risk in storing it in a bank vault. It's not insured. The feds have raided banks before, and if the bank closes, good luck getting to your gold or silver. So I don't like that option. So I use a private option. I don't store it in my home. I do store it somewhere in the Flathead Valley in Montana. I don't disclose where that is, and I feel, and it's safe and secure. So you can decide where you want to store it and what quantities you want to buy, but having something like this is a store of value if you ever need it. Now, you could also say, well, I've heard it said, okay, bullets, flour, sugar, chickens, whatever. Those are also a store of value. True, they are. And they're just not as convenient and as easily agreed upon the value as something like gold and silver. Okay, if you have questions or comments, leave them in the comment section below.